So again, this is a follow-up video on my previous two videos because in one of my previous two videos, one of my YouTube subscribers asked me a question saying, Rohit, I am working at a full-time day job. I am working at a 9 to 5 job. And sometimes I might be in meetings when the stock is hitting that yellow line. So, how do I handle that situation? I might miss the breakout. Just like I told you that I missed this stock, I was having breakfast. And during those 25 minutes when there was the window open where I could buy my shares, I could not do it, which was a stupid mistake, by the way. If that happens when he's in a meeting, okay, in the office, in the meeting, if that happens, then what to do in such cases? Okay, in fact, I have a student, I have a YouTube subscriber. She is a commercial airline pilot in one of the airlines in India, and she understands my system very well. She has studied all of my videos. She has prepared her own criteria based on the videos that she has studied from my YouTube channel. Only one question she had was when she is flying, she does not have access to internet. So when she is flying, at that time, if the stock triggers the yellow line, what do you do? Okay. This video is about answering that question. First thing you have to understand is there are two types of trades that you can take. One is swing, one is positional. So if you are uh, in a situation where you might not be available in front of the screen most of the times when the stocks are breaking out, I would say just give up swing trading altogether. You don't need to take swing trades, only stick to positional trades. Why do I say that? Because in positional trading, we focus on stocks that are fundamentally strong. In swing trading, we look at stocks that may or may not be fundamentally strong because we take swing trades only when the market is in a confirmed uptrend. At least in the beginning, when you are learning, when you don't have experience with this system, forget about swing trading. At least for 1 year, stick to positional trades. After your experience increases, you can add swing trading to your mix. If you are in a situation where you cannot catch that breakout, whereas if you are in a position where you can catch the breakout and you can be in front of the screen, then I would say you should be taking swing trades and positional trades. Okay. Now, let's say you are a commercial airline pilot and you cannot be in front of the screen. You are flying while the stock is breaking out, right? What do you do in such cases? First thing you have to do is after you identify that yellow line, the yellow band, this you can do the night before, right? So this is the yellow line which is 1109. So first thing you have to do is you have to put a alert. Okay. Alert at 1107, maybe 2 rupees below that yellow line. So when the stock starts to go up, your alert gets triggered. You know that the stock is going up on high volume on the lower time frame chart. The alert is at 1107. If it hits 1109 on high volume, closing in the yellow band on the intraday time frame charts, that is the time to buy. Okay. So if you are in office, you are not having any meeting, your alert will go off on your mobile phone. You can quickly check your mobile phone, look at the intraday time frame volume. TradingView application is available on your mobile phone. You can quickly check volume on the intraday time frame. If the stock enters the yellow band, you could choose to buy some shares at least. Out of 100, you could choose to buy 25 or 35 shares. Okay. That is how you would approach with the help of alerts if you are not in a meeting. Now, if you are a commercial airline pilot, you are flying, you can't even get the alert, right? What do you do in such cases? In such cases, you only have one option. You have to place a GTT buy order. GTT buy order is an automatic order that gets triggered when the price hits this yellow line. So, in the GTT order, there are two prices. One is a trigger price, one is a limit price. So we have to put the trigger price as 1109 and we have to put the limit price as maybe 2 or 3 rupees above that 1109 price. I have made a separate video on how to place a GTT buy order. A GTT buy order is a automatic order. It automatically buys the stock for you when the price hits the yellow line. Now, what is the risk with the GTT buy order? Well, when the stock starts to go up on this particular day, when the stock starts to go up, it touches the yellow line, it triggers the order, money gets deducted from your trading account, you get the shares. After that, what if the stock starts to fall? That is the risk. Another risk is, what if the stock triggers the yellow line on lower volume on the intraday time frame chart? Huge risk, right? Imagine you get an alert, the stock enters the yellow zone, but you don't see any volume. So, which means the stock is going up on low volume. That is not a true breakout. But you are a commercial airline pilot, you are flying, you can't check all of this, right? You have to place a GTT order to buy the shares automatically when the yellow line is touched. So now you are incurring additional risk. Maybe the stock touches the yellow line on low volume. That is a risk, right? Maybe the stock touches the yellow line and then starts to fall. That is another risk. So, how do you control that risk? Well, I have been repeatedly telling you there are only three ways to control or manage risk. Number one, reduce your position size. Number two, move your stop loss up. And number three, do both. Okay, reduce your position size and move your stop loss up. Now, how can you do all of this when you are flying in the air, right? So, the solution to this problem is, while putting the GTT order itself, when you are putting the quantity, instead of 100 shares, does it not make sense to put, let's say, 25 or 35 shares in the order, right? Or maybe 50 shares, maybe put half position size. Automatically, you are controlling risk. Okay. You are still sitting on risk because the stock gets triggered and you're flying in the air and you don't have time to keep the stop loss, right? Only when you land will you get the time to see what happened while you were in the air, and then you would get a chance to keep the stop loss. So you're still at huge risk. It's like getting into a stock without putting a stop loss. That is huge risk. But what can we do? There are constraints, right? So that is why we go in with a small position size. So on that, my student asked me a question. Well, in that case, then I will never be able to buy a stock with a full position size, right? Because I'm a pilot. I'm flying in the air. How will I get a chance to buy full position ever in any stock? That's a valid question, right? Well, the answer to that question is, not every time you are going to be in the air, or not every time you are going to be in an office meeting. Okay, let's say you take maybe 100 positions in a year. Let's say you take 100 trades in a year. There is a good chance that 50% out of those 100, you are in a meeting or you are flying, and the remaining 50, you are actually there. You are actually there. You have your mobile phone with you. Okay. So look at the percentages. It will never happen that every time the stock triggers, every time you are not available. That is less likely to happen in the overall scheme of things. If you take a 1 year perspective, out of every 100 trades you take 50, you will be able to catch at least 50% of the shares. Okay. And these days people work from home, right? So if you're working from home, even while you're in a meeting, okay, generally I see uh, IT professionals, when they are in a meeting, they don't switch on their camera. Okay, so if you are in a meeting, anyways, the camera is not on. So if you get an alert, you can quickly put the order, come back to the meeting, or if you are hosting the meeting, you could ask people to take a 5 minute or a 10 minute break and then put the order, put the market order, buy the stock, put the stop loss, and come back to your meeting. That can be done. Being a pilot is that's very restrictive. There are a lot of constraints there because you don't have internet access. But that does not stop you from keeping a GTT order. The that is why I said stick to positional trades, because when the stock hits the yellow line, the probability of coming down is more for a swing trade than a positional trade. Because in a swing trade, by default, you are going with a stock which may or may not be fundamentally strong. That is why I say when you eliminate swing trading from your system altogether, there itself, that decision itself is reducing a lot of risk for you. So when you are buying, you are by default buying a positional stock. You are by default buying a fundamentally strong stock. So the risk that the stock will come down or the risk that the stock will hit the yellow line with low volume, that risk is reduced to a significant extent. In fact, if you check William O'Neill's career, oh, it's a 5 decade career. Okay. During those 5 decades, the guy only bought one stock which was fundamentally weak. I checked in one of his interviews, not his interview, one of his associates' interviews. He said that in his entire 5 decade career, he only bought one stock which was fundamentally weak. And William O'Neill, by the way, is a legendary stock trader. So you can take a cue from that. You can take encouragement and motivation from that and give up swing trading altogether. Only stick to positional stock trading. When I say only stick to positional stock trading, I am not saying only trade the weekly charts. You have to trade the daily charts because the buy point, you get a better buy point on the daily chart. Okay. You could put maybe half of your planned position size on the daily time frame chart buy point as explained by me, and the remaining 50% you could buy it at the actual pivot point as per William O'Neill's method. There is a difference between buy point and pivot point, on which I have made a separate video which you can go back on my YouTube channel and check. You can put a GTT order on the buy point with 50% of your planned position size. Remaining 50 you can buy manually later on a weekly time frame chart on that pivot point. Okay. This is the best recommendation or solution that I have for you when it comes to trade execution. This is the best we can do. Just because you are in a meeting or just because you are flying does not mean that you cannot use this strategy effectively. In fact, this strategy demands that you slow down. Okay. This strategy demands that you be more strict with your criteria, especially when you know that you cannot be in front of the screen to catch the stock at breakout. So I believe I have addressed this problem to those people who cannot be in front of the chart all the time while the stock is breaking out. You could go in with an automatic order, but then you have to control the risk with by entering with small position size and giving up swing trading altogether. Okay. So being very selective, being very strict with your risk management and stock selection criteria. Thank you so much.